So the variable expense ratio is a ratio of variable expense to sale. How we calculated this 60%, simple variable cost divided by sales. So it can be calculated on unit basis as well, can be calculated on total number basis as well, right? So let's just see that. What is the profit impact if racing bicycle can increase unit sales from 500 to 540 by increasing monthly advertising budget 10,000? So up till now, what we have discussed, we just vary one variable and then we find out the impact. But now we are changing two variables. We are selling the number of units of bikes, we increase it, and then we also increase our monthly budget, right? So first of all, we need to verify, segregate that whether this is fixed or whether this is variable. So we know that if we increase or decrease the number of units sold, okay, that will increase our variable cost as well, okay. So monthly budget, it means we are increasing this in our fixed cost, right? Now what will happen to the profit? So contribution margin remains the same, right? Because there is nothing, change on per unit basis. We still have 300 variable cost, 200 contribution margin, right? So let's do that. So our sales increase, right? But our fixed expense also increase. Here we go. 40 units are sold above. So 40 multiplied by 400. Oh, sorry, 200. 200 is over. The 200. Answer would be, so this would be 8,000 increase in our contribution margin. But increase in monthly budget is 10,000. Answer would be loss of 2,000. Right? So there are a number of ways you can do that. If you really understand the spirit of calculating contribution margin ratio, contribution margin per unit, so it's easy for you. So in my previous semester class, many students they were just quite puzzled or confused regarding what's going on. So it's just up to you. So there are a number of methods to calculate this one. So we have quick hacks, we have shortcuts, we have full-blown question as well. You can also do it by following the sequences of sale minus variable cost, contribution margin, and you can also do it in quick methods, because we know that our break even is okay. We know that at 500 units, our contribution margin is 100,000. At 540, it would be, we know that 40 multiplied by 200 CM ratio, it would be addition of 8,000. So 108,000, right? So extra would be the 8,000 that we would be receiving after increase in sale of 40 units. But how much we are paying for advertisement, monthly advertisement, 10,000. It means we are losing here 2,000 money. $2,000. Come on. 2,000. That would be 2,000 loss. So this strategy is good? No, this strategy is not good. Why? Because we are, though we have increased in sales 20,000, right? But even then, we are decreasing our income by 2,000. So there is nothing, good for this strategy, right? 2,000 loss here. Okay, let's take a 10 minutes break and then we talk about the other one. What happens if we increase more than the other one and we are not increasing our fixed cost? Let's just talk about after 10 minutes. Okay, class, welcome back after the break. So we said before the break that we will be doing this example. So let's just talk about this. So the change in variable cost and sales volume. So before that, what we have done, we have changed the the sales volume and fixed cost. But let's just talk about that. What if we change the variable cost and the sales volume simultaneously? What happened to the profit? So what is the profit impact if racing bicycle can use higher quality raw materials, thus increasing variable cost per unit by $10 to generate an increase in units from 500 to 580. So previously our variable cost was 300, right? So our new variable cost would be 310. Our new variable cost would be 310, right? So let's just solve that one. So profit impact is profit is increased by 10,200. How? So our sales are increased by 80 units. So 580 multiplied by 500, 290,000. 310 multiplied by the 580 units, answer would be 179,800. So we didn't change our fixed expense. Our fixed expense remains the same. You see here, our sales are increased by 40,000. 40,000 increase in sales, leading us with 10,200 profit. See, so let's compare this with our previous solution when we change the fixed cost here. Our sale is increased by 20,000, leading us having 20,000 loss instead of any increase in profit. Okay, right? You can also find out using the formula as well from different formulas. Okay, in order to find out the profit is equal to the CM per unit multiplied by the cost of unit sold minus fixed cost. In that case, you need to find out CM per unit, as we have 500 sale price, 310 is now our variable cost, so 190 would be our CM. CM 190 multiplied by 580 minus 80,000, answer would leads to 30,200 as well, right? Now, what happens if we change the fixed cost, sale price, and volume simultaneously, right? Let's talk about this. What is the profit impact of RBC if it cuts its selling price by $20? It means $480. Increase in advertising budget by 15,000. Total cost going to be, a fixed cost going to be now 95, right? 80,000 plus 15,000 here. and the units sold going to be increased by 150 units, right? Let's just solve this. See where this 312,000 came from. 650,000 multiplied by the change in sales. Sale price, the total sales would be $312,000. Our variable cost remains unchanged, right? Or do we have a change in variable cost? No. So it means our variable cost is 300. So 300 multiplied by 650, answer would be 195,000. So we have 117,000 contribution margin. Look at that. There is an increase in sales by 62,000, but the profit is only increased by 2,000. So from these three examples, what you have learned? In one case, you are having in scenario one, we just change the fixed cost and number of units sold. You are having increase in sales 20,000 leading 2,000 loss. You increase in variable cost and quantity 40,000, right? Or 40,000 leads to 20,000, I think 300 or 800 maybe. But if you change fixed cost and sale price, answer would be you increase approximately 60,000 and there is only 2,000 increase in profit. I think this is 10,000. See the power of fixed cost. What we have common here, we increase 10,000 budget here of fixed cost. It leads us a huge change in profit. Even though we managed to sell 150 more units here, even then we could only increase a minimum profit here. What is the reason? Because we increase $15,000 fixed cost, right? What we have learned from these three examples, that fixed costs do have a great impact on your profit, right? Let's just go back to our slides and see one more time. So we have increased our fixed cost 15,000. We saw, even though our sales are increased by 62,000, merely increasing 15,000 on your fixed cost is having a huge impact on your